Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So obviously, there's a lot of geopolitical risk out there. We have the Fed's decision coming up soon. Let's talk about expected bond market volatility, kind of the VIX of the bond market. The MOVE index up at a very high level has been spiking recently. Number two, Russia and Ukraine. Obviously, that's gathering all of the headlines, and rightfully so. Let's put Russia's economy into perspective. And even though it's declined dramatically, why we're not seeing widespread panic throughout markets globally at this point. And then finally, US small caps quietly starting to show a little life during the latter part of February and the early part of March. Is this the beginning of a trend that we will see continue? So as I talked about on the chart here, we have the MOVE index. That is the implied volatility of multiple maturities of US Treasury options. So what does that mean? It's basically bond market participants' assessment of expected volatility or risk in the bond markets. And it's jumped up to its highest level since the financial crisis, to levels we also saw back during the early stages of the tech bubble. Now, why has this happened? It's a couple of reasons. We're a couple weeks away from the March Fed meeting, which many people expect, including Federal Chairman Powell, even commenting in the news this past week that he will propose a 25 basis point increase. But if you look back just a few weeks ago before some of the conflict, some people expected as high as a 50 basis point hike in March and potentially up to 7 rate hikes throughout the end of the year. With the increased volatility in the stock market, with the uncertainty around the geopolitical risk with Russia, Ukraine, Western Europe, and the United States right now, we're seeing a couple things happening. Expectations for that 50 basis point cut have moved back down to 25 basis points. We've seen equity market volatility increase dramatically. We've also seen the yield curve start to flatten. So even though short-term rates are moving pretty quick in response to expectations for that short end of the curve to get pushed higher by Powell and the Federal Reserve, longer-term rates are not moving so higher. Historically, if that reaches a point where it becomes inverted, where short-term rates are actually higher than long-term rates, that could be a concern from an economic perspective, that participants are saying, hey, the Fed's raising rates a little too fast, and we think economic growth will not be able to keep up with this higher rates. All that to say, Powell and the Fed is in a little bit of a difficult position here right now. They'll obviously be able to sort of begin this tightening cycle at a slower pace if they choose to do so. But bond market's saying, hey, there's a lot of unexpected potential volatility out there in the coming months. Now let's take a look about Russia. They've been in the big news. You've heard the stock market's plummeted nearly around 50%. Currency has been plummeting. We have experienced a little bit of an increase in volatility here in the US after this Ukraine-Russia conflict began, but we're not seeing widespread recessions across the globe. And here's probably why. Number one, if we take a look at the global stock market, Russia is 0.4% of the global market cap. If you look just within that emerging markets equity space, it's 3% of the emerging markets universe. Now, if we look economically, global gross domestic product, what are they producing on a global scale? 1.6% of the global economy. So rather small player from an economic perspective. And even China, they obviously have strong relations, but they're still only 2% and 3% respectively of China's total exports and imports. But the big one that you see in the news is an oil supplier to Western Europe as well as the United States. In fact, the number two, just past Mexico, but it kind of goes back and forth between Mexico and Russia in terms of the number two oil supplier to the United States. We've recently seen Biden come out and talk about releasing some of the reserves that the US has. Perhaps that will alleviate some of the dependency, but that's the real connection from a US perspective. But globally, if we think about from an economic and stock market perspective, Russia on its own, still a rather small player economically on the global landscape. And finally, within the US, small cap stocks have been underperforming since the first quarter of 2021, something we've outlined as one of the big risks to start this year is that underperformance, as well as underperformance in mid caps. And what we've seen is that has trickled into large cap volatility during the start of this year. So I think if you want to see an improvement in the overall breadth of the stock market, I think part of the story starts here. And this is a relative strength line of the Russell 2000 small cap index versus the S&P 500 large cap index. And it's obviously been in a downtrend as the Russell declines relative to the S&P 500. If we are going to see a resurgence in participation, I think you're going to want to see an improvement in this line. We have started to see that during the latter part of February, early part of March, but I think it's a little too early to say this is over right now. We've obviously seen little ebbs and flows in this downtrend during this broader context, during this 12-month, 14-month period here. But I think you're going to want to see more, and it's kind of still within that downtrend. But this is an area to watch for if you're looking for improvement or areas for the market to kind of firm up here. I think it starts here. And finally, I want to thank everyone for watching. We got the jobs report here in March for the month of February. 678,000 jobs added during the month of February. Some good signs. Obviously, the number of COVID cases dropped dramatically. We're talking about releasing some of the mask mandates across several of the states and really some of the countries around the globe. But on the US front, we're starting to see people get out there and search for work. Some of that we talked about was related to the apprehension or the unexpected nature of what COVID might do to the workplace. Well, perhaps some of those fears are being alleviated, and we're starting to see that resurgence. Some offices starting to open up a little bit more hybrid or working in office a little bit more. So maybe some early stages of returning to normalcy and getting that jobs market back to where it could be. With that, I want to thank everyone for watching, and I'll see you in a couple of weeks.